Welcome to the Monday Market Observations Call for the week of October the 3rd, 2022. I'm your host, Eric Jefferson, managing partner with TrestleBridge Capital. And to kick things off, just want to start offering our thoughts to those impacted by Hurricane Ian. I know there's still about 2 million people without power throughout the Southeast. Our thoughts go to them for a very quick and speedy recovery. We also have just a few words to keep the lawyers happy here. And as we dive in, recapping last week, unfortunately, last week was a continuation of what we saw throughout the third quarter and really all of this year, with both stocks and bonds trading lower. In the last 3 months, which again last week ended or rounded out the third quarter, S&P traded down about 6%. The Bloomberg US aggregate, that's the most widely accepted benchmark for fixed income, that traded down about 5%. So again, continue to see lack of diversification benefit between those two asset classes. As well, the Q3 sell-off brought in new year-to-date lows for both index. The S&P touched down just around 24%. The bond index around -15. Again, fresh new lows for both stocks and bonds in the quarter. And as we've seen volatility time and time again to pick up, so too have correlations, which has increased or which in turn reduces the diversification benefits, making this year an especially challenging one, even for moderate risk investors. That is a theme we're going to explore in much more detail later this week when we release the Q3 market and economic commentary. I'll also take a deep dive into some of our portfolios, review how they're allocated, the instruments that we incorporate, ultimately their end performance, and then the outlook for the balance of this year. Going back to last week, as I mentioned, stocks and bonds traded lower. That was a function, though, of good news is bad news. We got some slightly stronger than expected economic data, home prices, new home sales, durable goods. Those again suggested the economy is actually doing all right. Although then, as we've seen time and time again, received reports that inflation has not yet made any progress. We got core PCE data last Friday. Again, did not show any change in direction there, which the market then interpreted or added further fuel to the higher for longer camp. Again, meaning that the Fed is going to continue to increase, having more restrictive interest rate policy in order to combat inflation, which has not yet shown any signs of slowing down. And that being said, on a somewhat constructive note, we do have stocks up early this morning. That was largely due to a response from the Bank of England announcing they were going to come in, intervene, and buy government bonds. As well, the previously announced tax cut catering to the higher earners was being walked back. If you recall, that was a new piece of legislation from the newly elected PM. Obviously, that was done in an effort to stimulate the economy. But if you go back to Econ 101, that represents a very accommodative fiscal policy. Again, fiscal is done by governments. That refers to taxes and spending. That was in sharp contrast to a very restrictive monetary policy done by central banks. That refers to interest rates and reserve ratios. And again, where you saw those two policies somewhat in conflict with one another, not surprisingly, that created a lot of turmoil in the currency markets. And so great to see leaders come together, ultimately do, in my opinion, the right thing that had to be done. Many quoting or calling this morning, referring to this as a Lehman type moment. So again, obviously sidestepped, but great to see folks come together when we ultimately needed it. Unfortunately, it's not something that we could say for leaders across the globe. Last week, Putin annexed 4 parts of Ukraine. That, in my opinion, probably only intensifies the situation over there. That's following what has been some clearly more intense language from him. Not a geopolitical strategist by any means, but arguably that does not improve the situation. That also coupled with allegations or reports that leaks in the Nord Stream 2 pipeline were the result of Russian-induced sabotage. Again, not a geopolitical strategist, but likely suggests that pipeline will not be coming back on by the time winter gets here. That further fuels the concerns around an energy crisis for Europe headed into the colder months. When we think about the week ahead, did get some weaker ISM data this morning. That I think is also having a somewhat positive impact on markets. Again, the opposite of what we saw last week, where bad news is potentially now good news. We also have services PMI on Wednesday. So I think the most important piece of this week is going to be jobs report on Friday. Again, as we've talked about, there's a very large disconnect between the number of available jobs or number of jobs currently looking to be filled and the number of available workers. And so as there continue to be significantly more jobs versus workers, that puts upward pressure on wages or what a company has to pay somebody to work, which in turn typically translates to stickier inflation. So again, until we have somewhat of that coming back into balance, don't know that we could expect any meaningful progress on inflation. As a result, when we think about current positioning, we do still maintain our fairly conservative allocation relative to benchmarks. That's something, if we did get a sustained rally here, would likely underperform. However, we think about the outlook for meaningful gains and markets to take place, really need to see progress with respect to geopolitics, primarily in Ukraine and Russia. We'd have to start to see some progress on inflation, as well as encouraging data with respect to growth. And then I think the fourth and really key theme here is going to be, as we hear from corporate executives in the weeks ahead, we're going to kick off Q3 earnings season. The focus is going to be how resilient can companies continue to be. We talked about companies have faced a myriad of challenges this year, but thus far have been able or have successfully been able to pass along a lot of those higher input costs to end consumers and maintain what have been record profit margins. The concern, though, at some point, if demand is no longer there or diminishes, are companies going to generate the earnings that the market is expecting, and ultimately what happens if they don't? So something we will continue to monitor and report back on a weekly basis here. On a final note, I do want to end on a more constructive, positive announcement. Biogen, it's a pharmaceutical company. Kudos to the hardworking men and women there. They recently had a very successful drug in clinical trials aimed at reducing the negative impacts of Alzheimer's. I know that's something everybody listening to this replay, in all likelihood, knows somebody that has been impacted by that disease. So kudos again for their hard work, trying to make the world a better place. That's all for now. As always, happy to discuss anything in more detail. Have a great week if we don't connect. Take care.